The following is a consolidation of the analysis shown in our New Year's show, with our projections for 2021 in oil, bonds, the dollar, gold, and the stock market. If you're new to Ask Slim, we hope you find this analysis compelling. If you've seen it already, well, it's a good opportunity to review. Please do go to our website at AskSlim.com and explore that site. If you're watching this on YouTube, please subscribe to the channel. Make sure that you give us a thumbs up and you click that little notification bell and you'll be notified when we put out videos. Follow us on Twitter at AskSlim. And for more information on our memberships, please write Matt at AskSlim.com. Please enjoy this replay. Let's get into our view of 2021 in the 5 major markets. We're going to start out by looking at light crude and do our projections for 2021. First thing I want to show you when I look at this, though, is a blank chart, because I want you to see the nature of the kind of work that we do. There are so many of you now that are watching this that have never seen what we do, and so many of you that are watching this that are learning about how to look at the markets the way that we do, looking at markets in time and price, which is what cycle analysis is. It's essentially a look at the money flow of the markets in a visual way with recurring patterns that when you look at a chart like this, you'll say, well, you know, I see a lot of bouncing up and down, but are there really recurring patterns? Well, I want you to see that as we switch over to our work on the CL chart. And there you have cycle analysis right in front of you. I'll give you a little bit of an overview of what that cycle analysis looks like right now as I take my pointer here and go through this chart in some detail so you get a pretty good idea of what's going on. So the first thing I want you to note is that there is what we call a cycle bracket on the bottom. This is just a drawing tool. It's set at what the average length of cycles are. A cycle is measured from low to low, as you can see right in here, low to low. And these cycle patterns remarkably are consistent. You can see this was 16 months from the previous low, 15 months, 19 months. This was these were long cycles at 18 and 19, and then you had this extremely short cycle. Sometimes we have to deal with that where it comes outside of what we call the principle of variation. 15 months, 18 months, 16 months, you could see the beautiful cyclicality in here as it moves the way that it does, and we learned so much from the patterns also. I want you to note there are 3 head and shoulders patterns in here. This one right over here, it measured to here. You could see the measurement, perfect. A small inverted head and shoulders made the upside correction. It measured right up to here, and what that gave you was a perfect touch and hit the resistance, and then a head and shoulders continuation pattern which came down and projected to here, and also a perfect touch, as you see right there. Just absolutely beautiful patterns. And we look at candlesticks and things like that. So this is what cycle analysis is. The yellow ovals are corrective phases. We sometimes put these in here so you can see when you get into the final stages where the cycle is correcting or pushing down is when you have the biggest downside risk, as you can see. And that turns out that it's going to happen here in this year where we're likely to get a correction. I'm going to take a closer look here for you to see, and of course you can go to AskSlim.com and you can learn about cycle analysis by taking our cycle analysis workshop. For the year 2020, there was a change of a loss of about 21.5%. Cycle analysis projections, as you can see right in here, as this just made the low here back at the April lows right there and now has been moving up. So our projection is for it to peak somewhere in Q1 or Q2. You can, maybe it'll come up here, come down, and then maybe test those levels. We're looking for an expected range of 54, which is about the bottom of this fib confluence there, and then a decline for it to close near the lows for the year to somewhere around the $35 area. This is the support zone right over here. This is the corrective phase right over here, and that takes you down here to Q4. Now, it'll probably give up a lot of ground in here. It might fall even as low as 31. We're going to look for about 35, 36, and then probably get a bounce somewhere out over here, but closer to the lows for the year than the highs for the year is what we think is going to happen. So this overall is a pretty negative scenario, and in order for that to happen, well, you figure that something is going to come out in here in the markets that is going to be, well, back in that deflationary mode that I talked about in the early part of the show. So for the year, we're looking for a lower year for the light crude market after coming and trying to test up this resistance area near the $54 area. That seems the most likely to us, with that peak coming somewhere late Q1, maybe a test up there in Q2, and then a weaker time period over here for the energy market. So that is a look at the energies like crude, and a good sense for how we look at the markets and with our time and price analysis and all the things that we put in there. We also put in a lot of momentum indicators that I'm going to show you as we get further on in the show, how important momentum is. What you're seeing in here is how important the putting in the resistance levels, support levels, and doing the targeting the way that we do them. So that's light crude. Last year, a big loss, and this year, probably failing after some kind of rally. So that's a look at the five, at the beginning of our look at the five major markets as we look at the light crude market. So now we're going to continue with our look at the major markets, and we're going to move into the dollar. The dollar has, of course, been slammed as we have seen the Fed and other central banks printing like crazy. And the 6-something% drop by the dollar may not seem like that much, but it's big for the dollar. And overall, the reflection of commodity prices, and specifically gold and Bitcoin and silver, they had such big years. Well, Bitcoin beyond anybody's comprehension. Well, except for maybe some of those people that thought it's going to 25 or 50,000 that have been proven correct at this point. So now let's take a look as we switch over from this light crude market to $DXY. Again, what we're looking at in here is cycle analysis. And you can see in here now, as we bring in a little more advanced things, is that there are cycle harmonics in here. We call these harmonic families. You can see where there's low lines up here. There were 3 cycles right over there that bottomed. Where the low lines up here and 3 cycles bottomed, you get a pretty big size decline. Here you got, well, a more modest decline as it fell about 8% down right in here. And here you could see kind of a mid-cycle where there were only 2 cycles coming down there, as here and here you get those bigger declines. So coming into our analysis last year in 2020, what I had said was, let me just bring this in a little bit closer for you right here. What I had said was that, well, we thought that the stock market, that the dollar market would fall. The dollar was projected for a large drop, and it ended up moving down close to 7%. For the year right now. The cyclical projections that we had were that you had this formation right in here, this diamond, and then it was likely to break down and move down. We projected it down to 88.20, and you could see it got very, very close right over there. The decline we thought would actually come down into 2021, and we still think that there's downside to come. We're going to project in here, because we have these 3 cycles that are proving to be coming down together, that it is very likely to continue downside with a low between May and July. The expected range is 84 to 94. So we think it'll get down to 84. Now there's support at 88 right over here. It could stop there. This is the 84 level right over there. And you can see that the message I had in here was a period of extreme risk started in July 2020, and it projected down into April to July of 2021. So that was the old analysis, and we tightened it up a little bit here, May to July. And that says to us that you'll get down in this period somewhere down 84 to about 88 to about 84, and then turn up. And we expect a small change on the year. The reason for that is because we expect it to bottom in here. And because we believe that the deflationary forces will re-emerge, that's going to make money, cash money, dear again, and likely going to be responsible for what we think is going to be a negative period for the stock market, and we'll see the dollar recover and come back. So you can see the major bottom that's right in here. And if you look at this nested area right over here where the correction came, once you got where these three cycles were rising, you got a big rally, and that's coming right over here. Actually, if I look back and you look at these big harmonic families, you can see right over here, let me just take a peek right there, where these cycles bottomed right in here, and it got hit like we are right now. You had this giant rally where all cycles were moving up. So you had that here, and you had that here, and that's why we believe the dollar low will be made sometime in this spring to summer period, and then be moving up again. The question is, will it be a huge rally as deflation really, really is powerful, or will it be only modest and come back? So overall, what we're projecting is that it will come back and only be a small change for the year at the end of the year, but it actually could be, in my opinion, up for the year, depending on how much other markets get sold and how scary it gets, assuming it does at some point, when it appears that the Fed's liquidity is going to dry up. So that's a look very much at the dollar index, and you can see the beautiful cyclicality in there and the harmonic families. The cycles in there you can see are 20, 40, and 80 weeks. Remember, our level 4 members, they can ask us for these charts if they wish, and we'll be glad to give those to you because they are for the Thinkorswim platform. So beautiful looking cyclicality in here, and a pretty clear look at what we think will happen to the dollar down into sometime into, we'll say, Q2, and then coming back. That's really what it looks like to us using that cycle analysis. So now we're going to look at the gold market as we look at the precious metal that has had just a very, very significant upside move this year. The move in silver was similar, and our projection in silver is going to be similar also as we look at this gold market. So let's take a look as we switch over to gold. So I'll move from the dollar market to the gold market, and here you could see the cycle analysis that's there. And again, there are harmonic families in here. If you haven't experienced our cycle analysis workshop, please go to AskSlim.com to workshops, and there's a video there and an explanation of what you can learn by taking that workshop. So the gold market up 25% on the year, and as I said, our intermediate analysis on the weekly charts and daily charts has been terrific, and our members have had great success this year trading the gold market. So last year we expected that gold would have a dip that went a little further and a little later, a little earlier than the dip we're getting here in the fourth quarter, but we did believe it would be up some 15% on the year, and it actually has a change of 25% up on the year. So we did really well in direction, and our regular weekly analysis on it's been great. Again, the periods of high risk are those ovals, and you can see that it's likely one is going to start sometime in 2021 into 2022. Again, that deflation that we talk about, we think is going to show up in the gold market. As we said, we think the dollar will bottom sometime this year, and they often trade inversely to each other. December 2020 is a rally phase in the fourth minor cycle. So that's right in here, this fourth minor cycle right there, and you could see that it turned up, came down to close to support, and then began to move up. Our projection for 2021 is a peak in the May to July period. Now remember, we're looking for a bottom in the dollar in a similar period. And then, again, moving inversely, the dollar should be rallying, the gold market should be moving down. We're going to look for the gold market to test the old high or get up to that resistance right over there, that fib extension that you see, which is up in that area of about 20. This resistance here was 2045. It got through there. It traded up to 2089. We think it will likely test that and potentially get up to this resistance area right there or right over here, 2230. That is where we're going to project to, even though it might actually, we have it on the chart projecting to this level at about 2115. So it's 2115 to 2230. It's kind of the range of where we expect it to get up to. Then we expect it will decline to about 1700, and that takes you out into 2022. So it's hard for us to tell how sharp the decline right now would be in 2021. But it certainly looks like down into 2022, it's going to have a rough time. And let's just project right now that 21 and change up to 2230 is a pretty good target. And that's what we want to focus on because we think those will be the best trades that we have right now. If heaven forbid we're long and it gets down here under these lows around 1770, this will be over. The upside projection will be wrong. And the market will already be, working off of a deflationary scenario. We expect it will end the year kind of mid-range and maybe even small gains for the year because there's still a lot of time in here for it to make good gains and then give some of it back. So maybe small gains for the year, but it might actually be small losses. So somewhere near that unchanged area is likely where it will finish after having what we think will be another good rush to the upside. Now, there has been periods where you've had what we call the fourth minor cycle rally that failed very quickly. You can see that happened right over here. There's probably people that are bullish and saying, well, there's no way that's going to happen. If you look at the fourth minor cycle right over here, it broke out of that triangular shape right there and exploded to the upside. And then when it pulled back very significantly from 1,031 down to under 700. So over 30% drop in just that brief period of time right over there. So you could get something like that where it spikes up, makes the highs that we're looking at, and then begins to come down. Overall, we think the highest probability is that it will have a good rally into that May-July period, excuse me, and then pull back significantly and end the year kind of mid-range, small gains, maybe even small losses. That is a look at the cycle analysis for gold, where we look in time and price and do the projections that we always do. And you can see the beautiful cycles and harmonic families in here. For those of you that are students, we're looking at cycles of 84, 42, and 21 months. Pretty close to the principle of nominality, which is 80, 40, and 20. And beautiful rhythms in here. As you can see, the important lows come at the very right times. You can see the low right over here. You can see the low right over here. Just perfect cycles that you see in there. And if you believe it's going to continue with some near perfection, then this is the analysis that we just gave you that we think will be accurate. A surge up and then giving it back. That is a look at the gold market for 2021. Let's take a look at the Treasury market right now as we continue with our look at the major markets for 2021. We're going to look at Treasury notes and yields. I'm going to start out by looking at the yields market because this is such an informative chart. I've made a case that the near 40-year bear market for the bonds, the bull market, or 40-year bear market for yields is over. And that when we saw the panic, when we saw the yields get under 40 basis points, that was it. We're not going to see that again. There is no way that we're going to see Powell go to negative interest rates. He knows the destruction that causes, and he has said it numerous times. So even in the worst of crises, we're not going to see that. And the likelihood of us seeing 40 basis points again, I think is very, very small. We're going to switch over from the gold market here to TNX. This is a phenomenal chart. Talk about perfect cyclical rhythms. You can see that. I want you to note the green phases in there. Those are the rising phases for interest rates. And if you look at these cycle harmonics in here, you have a dominant cycle, as you see right over here, and you have the minor cycle. And you can see how the minor cycle shows up within the dominant cycle, the two halves. So it's a minor half cycle and a full dominant cycle. After you get the nesting right over here, where they're both coming down, in other words, yields declining right into the expected low time frame, you get a rally after that in yields or decline in bonds. Each of those rising phases have lasted between 6 and 28 months and have retraced at least 50%. Now I'm going all the way back here to 1997, so we're looking at about 23 years right here. This is just phenomenal. You can see all of these green zones bringing big upticks in yields, at least to 50%. Look where we are right now. What that says to me is that it is extremely likely that we're going to project to 1.5 to 1.9%, 1.9% or more is reasonable in my opinion, into this coming 2021 and maybe even into 2022 when we look at this. It depends on how long this rally phases. Again, they are between 6 and 24 months. And let's just go back out over here so you could see 6 and 28 months, with retracing up at least 50% of the decline. So that would mean that we're going to get probably up to that 50% retracement that you see right there. And that would be taking you up to the area of about 1.9%. Well, what does that translate to in the futures? I'll show you that in a second. Look at these harmonics. Look at the gorgeous cycles that are in here, and it tells you that we are in a period of rising interest rates right now. Now, the stock market can stand that for a while, but if interest rates start to spike, which could happen at the slightest hint that the Fed is done or that COVID-19 is going to be solved, the vaccines are going to work, the reality of what the valuations of the stock market is now. There are a multitude of things that could push these yields up very high. And if you go back again and look at 2018, the potential of them being able to raise interest rates just disappeared very, very quickly. They were trying to raise interest rates right here. And of course, we got into this repo crisis, and it shows you what bad shape our economy is in without all this funny money printing going on. So I have declared that the 40-year bear market in yields is over. And you can see I have noted that right over there. And that we are going to start moving up pretty significantly in yields. So we're projecting a 1.9% yield likely coming in 2021, and maybe it takes out until 2022. And I got to tell you, it could be higher than that. Remember, it's at least 50% upward retracements that you've seen there, and some of them have been 78.6%. So that is a likelihood that we're going to see yields moving up. So how does this translate into the cyclical action that we see in the 10-year note market? Here is the 10-year note market that we see right over here. We'll let you see the amazing cyclicality in here also. And an important thing that's going on right now. You can see those two yellow areas I've highlighted, and I'll explain that to you. So this is 10-year notes, and the average length increased from about 16 months, as you can see right over here, to it beginning to lengthen out, 18, 19, 19 right over there, and then a 20-month right over there. So we're getting a little longer cycles. It's averaging now getting close to about 20 months. Now, the rally phase, the low that was due to occur right over here, it came on 20 months, and then you got a rally that only lasted a couple of months and it started to come down. That's like what happened right over here. And you can see that we believe that we're going to start to get a decline in the bond market that looks like that. You're going to need to get a break underneath that cycle low support, 136.22, which would be very negative. That's that line that you see right over there. And once that happens, it will confirm the bear market in bonds that we are looking for and a very, very significant decline coming. Now remember, I talked to you about 1.5 to 1.9% yields coming likely in 2021. Well, based on the way this cycle shapes up, it says that this market is likely to decline right through the end of the year, 2021. Here is your 1.46% yield at about 131.23. So that would be about a 7-point drop in the ZNs. That's huge. 1.9% takes you down to about 129, which we think is a likelihood. So you can imagine how that extrapolates out into the, I think, better trader of the 30-year bond market, or 30-year bonds when you look at that. So for the year this last year, bonds were up 8.7%. Yields lost 1.75% to close the year around 93 basis points. Pretty big drop in yields in this big rally right over here engineered by the Fed. Of course, by a very, very slow economy. 2021 cyclical projections are for a high in the first quarter. So the high actually might come in January. I mean, very soon. We're not exactly sure, though. If we get the stock market decline that we expect into late February, early March, that's probably when you're going to get the high for the year in the bond market. The expected range is 139, 129. Now we're at 138.10 right now, so you can see we're not looking for much on the upside and then moving down. 10-year yield range we think would be down to close to 80 in March, and then 80 basis points, and then moving up to 1.9%. End the year near the low, and the bear bond market confirmed, as you could see that we have right over there, if we get a break underneath that 136.22 area. If it gets under there, you could expect a free fall, a big increase in yields, and a likely stock market drop that would accompany that panic. That's what we think is likely to happen, with yields moving up and leading the stock market down, which is not how it's been. Usually it's been the bond market moving up when the stock market declines. Well, we think we'll see that in March, but overall we think we'll see the yield market moving very much to the upside, and the bond market moving to the downside. So you can see the cyclical rhythms in here, just absolutely perfectly clear when we look at that. So that is our projection for the Treasury notes and yields for 2021. This is the Ask Slim membership page. If you go to AskSlim.com and scroll down, you will see this. And I wanted to give you an idea of our memberships that we have here right now. We have a free membership, and that allows you to see the Market Week archive, which has all of this great analysis in there, and you'll have access to that archive and notified for that, and some special free videos that we give you. Our level 1 deal, we call that one, and you can see deal, bet, raise, and all in. Yes, poker terms. I am a poker player. And this one for the level 1, this is a great membership because you get not only the Market Week show, you get our Stimulator Momentum Tracker, and you get the Stock Index Report, which is a weekly outlook, and the ETF Weekly Report. So you get a lot of reports in here, and there's some surprises coming for level 1 that we're going to be bringing you also. Level 2 is a great, it's great because you get everything in level 1 in there, and you also get our SIR daily snapshot, SIR intraday, which has the fantastic for intraday traders. It's our live stream, and 15-minute charts with the 3 major indexes for trading, and you get our entire library. It's actually well over 500 videos right now with these 9 different categories of videos that you get. For our raise level, level 3, you get all of that in level 1 and 2, plus you get our Stimulator ranking system of the 84 best traded symbols. Unbelievable. It has all of our algorithms in there. You get our trading ideas. RV runs that amazing, absolutely great work that he does, and he shows you a video and teaches you on every single one of those trade ideas. You get our live chart streams, which is in beta of the work that we do in the major indexes, and you get our weekly top chart requests. And level 4 members can ask us for analysis, and we share that with people in level 3. You get the static charts and learn about that analysis, and email support on general trading challenges that you can write to me or the team. All in, this is everything in levels 1, 2, and 3, plus you get my annotated cycle charts for the Thinkorswim platform. So you really need to be a Thinkorswim member, our preferred broker, and if you want to open up an account there, please go to the top page and scroll on that carousel and use our link. You get our chart grids and templates for the TOS platform, custom chart requests up to 2 a week, where anything you want us to look at, we'll do that for you and apply our cycle analysis to that. And you get actually our 3 proprietary indicators now: the MCI market condition indicator, OBI, the Slim option bias indicator, and then now we're adding the new Slim Ribbon PO, that great looking momentum indicator, signal indicator that we give you for momentum and for you to be able to direct your positions in a way that gives you the greatest advantage. So that's what the memberships are. You can see that. What is included in all this? Well, you get our unique and unparalleled technical methodology developed over 5 decades, because I've been a trader since 1974 when I became a member of the CBOE. I've also been a member of Chicago Mercantile, Chicago Board of Trade, and a hedge fund manager. You get our technical methodology, which is based on unbiased, bull-bear agnostic approach to charts and analysis. Yes, you might hear me bearish on the stock market at times, but we look at the technicals, and that's all that's important. We specialize in cycle and momentum studies at multiple time frames, and our premium membership levels support traders of all styles and experience, from intraday scalpers to swing traders to position traders and investors. Our team of analysts provide coverage of the major stock indexes, ETFs, futures, markets, with energies, precious metals, foreign exchange, bonds, Bitcoin, holy cow, and many of the most liquid stocks that are suitable for option trading. So really deep analysis in 84 of the best option traded symbols. Right now, you can get special rates. A 3-month trial membership. The rates that you saw on that page, well, we're going to beat those by a lot. You want to know about that for more info, write to Matt at AskSlim.com. He's going to send you a link, and if you have any questions about that, you will be able to ask him those questions also. So that's a look at our memberships, and I hope you found that incredibly interesting. We want you to become a member because your success is our success, and we work so hard to make you a more successful trader and investor. That's what we live for. So now we are going to get to the stock market. Our call early in January, beginning of January last year, was not great because the market volatility was just immense with that big break. We thought there would be a decline of some 12% and that it would then rally back and have a good strong fourth quarter with only maybe a small loss for the year. Well, we know what happened. We went into a total collapse because of COVID-19 and then a massive rally back to the upside as the Fed and central banks around the world poured liquidity into the markets, and the stay-at-home, work-at-home tech stocks that were supportive of that technology exploded to the upside with massive gains. Let's take a look at that as we now switch over from this bond market chart to SPX. So here are the cycle patterns here in SPX and our projections for this coming year. So all along we've been talking about 2021 being a rough year for the stock market. We're definitely unique in that is that most analysts think it's going to be another good year for the stock market. There are a few out there that are talking about the likelihood of some decline. We never want to be aligned with the doom and gloomers. We are totally agnostic. I have no problem being bullish. As you saw when we called the markets moving to the upside in the gold market, specifically in the oil market, we caught all during the last year as the markets were saying they were going up. The short-term indicators, our momentum indicators for the stock market, were great all year long. They never turned down. I mean, essentially, if you followed momentum, you were a huge winner. Here you see the cycle analysis going back to 2003, and you could see these large harmonic families. In this case, the harmonics, again, are close to the principle of nominality at 76 for the dominant, 38 for the intermediate, and 89 for the 19 for the minor. And all of these cycles really very clear, well, except for where they got swamped, like right over here, because there was barely any decline to see. So here you see we had this big decline when COVID hit, 35% to the downside. This was the mini bear that happened right over here in 2018, a brief one, 24% to the downside. So how did we do for the year? Well, S&P 500 up 15.6%, Dow Jones up only 6.2%. There were some stocks that struggled in there, specifically like Boeing. The NASDAQ, which supported all the stay-at-home activity, those stocks exploding to the upside for a 46% gain. And the Russell coming on towards the end of the year for 19%, as the stocks in there that benefit from all of the recovery that is expected really began to move to the upside. So now let's talk about our projections for the coming year for the stock market. We believe that there will be a peak in January to February, that the rally we're in now will be able to continue briefly. It is likely to get a test based on the intermediate patterns after that. So we think that there'll be a peak and a large decline into February, and then a test on the upside in the April to May period. It may be slightly short of the highs, it may be slightly higher. This is where we don't agree with almost everybody out there. We expect the range to be 38.60 at the high. Now we're looking at this fib extension right up over here at 38.60. It extends the megaphone that you see up by just a little bit. That then after that, it will then begin to correct with a correction into that February, early March period, another rally, a false rally, and then a big decline taking hold in here, and an actual bear market occurring. We believe 2021 will have a bear market. It will end the year closer to the lows. There are three nested cycles coming in right in here, which are likely to affect it in a very negative way. You can see what happened here after the 2007 peak. And those three cycles coming down, the three cycles coming down here, only a 16% decline in the 2016 mini bear. And then we're dealing with, and if you watch our last big picture analysis, I showed you the remarkable 7-year cycle, which goes down into 2023. So there are immense downside pressures on this market when we look at that. I'm going to talk a little bit more about that and then come back to the chart. This is a very important chart on stocks versus commodities. We give credit to Katusha Research for bringing this out. And you can see in here the beauty of this as you look at the disparities that are occurring or that have occurred in here. So this is when equities are expensive and commodities are cheap. And you can see that when that happens, the commodity market right over here, extremely cheap. What's going on right now, it was very, very cheap right over here in the relative to stocks in the tech bubble. You can see that right over there. So stocks exploded, and then this compares commodities to stocks, and commodities to stocks were basically on their lows right over here. And then when the stock market crashed and techs lost, some 80-something% of their value, that relationship began to change. In the financial crisis right over here, when stocks collapsed, then of course commodities were high relative to stocks, and look where we are right now. So if you want to make a case for the stock market going down and the commodity market doing better, This clearly screams at that right here. I mean, this says that stocks relative to commodity markets are just at a record disparity that we're seeing. So that makes stocks extremely expensive relative to commodities when you look at that. Let's take a look at another chart here. And this, thanks to advisor perspectives, that brings just amazing work. And I really recommend you go look at their site, Advisor Perspectives. This is a look at margin debt versus the S&P 500. So the Fed, which is in their brilliance, encouraged people to take on massive debt and made people believe that there is nowhere to invest other than the stock market, and if you don't invest in stocks, you're simply going to miss all of the moves, and force people to just be like the Robin Hood traders, investors, open up accounts, millions of them, buy stocks at ridiculous levels, and do it on massive record margin, as you can see right over here. The S&P 500 up to record levels here. The amount of margin, the margin debt, just absolutely at a record. Of course, these are inverse, so they flip the charts. So this is also a reflection of credit balances. Also, so what they did was they made these inverse to each other, so you could see record levels here of margin, record levels on the stock market, and when that begins to reverse, it does peel off quite quickly. November margin debt surged a record levels 9.5%. So you could see the money pouring into the stock market. Everybody wants to get in there before the market goes to that 42 to 4,600. And the amount of cash in mutual fund hands is at a very, very low levels, I think now under 4%. So the levels that we're seeing are just incredibly crazy. Take a look at one more chart in here I want you to see, and that is this Wilshire 500 to the GDP. I've showed this before. Thanks to long-term trends for this chart. This is a dynamic chart that they put up on their site. And with the cash manager reserves at 4% or less, this is the Buffett indicator, which looks at the market to GDP. It's at 183%. You can see over here at the dot-bomb period right there, where markets collapsed, it was nowhere near that level. 2007 financial crisis, even lower. Look where we are now. It's going to take a level of economic growth that is not possible to have this make any sense at all. That's what they're counting on. They believe that printing money equals growth. Print money equals growth. That's what they believe. That's their the core of how our leaders in this country running the Fed, that's how they operate. They'll do anything to keep what looks like deflation from happening, and what they've done instead is caused inflation in asset levels to this, which is a pending crisis in the stock market, with all of these young novice traders getting hooked into the market right now, and people afraid to sell. And believe me, they're not going to sell until they have to sell, most people. And I'm warning right now that if you're not going to sell, when will you sell? If you won't sell now, when will you sell? It makes no sense to me to not be lightening up in an immense way here. It doesn't matter if you miss more on the upside. Preservation of capital at these levels is what makes the absolute most sense. So let's get back to that chart that we're looking at right over here. Again, what we see in here is the likelihood of a peak in the stock market coming early in the year. Probably going to get a decline of some significance into sometime into the late February, March period. We have showed that on our weekly charts, which you can see which will show in Future Speak coming up next week, and then another potential uptick in there to test the high, maybe not, and then some very, very weak period over here as all of these cycles begin to move down. Our most optimistic call that we can make would be a decline over here to this level about 2,900, which would be a 25% bear market at the 61.8% retracement level. That would be what we think would be kind of a best call, with a potential to get down over here around 2,700. Also, some people are looking at this and saying this guy's nuts. Of course, if you look at markets going back in history like I do, these bear markets come and come and come. Excuse me for this cough. This has been a very, very long show. So again, we think 2021 will have a bear market in it, and that it's going to end closer to its lows. Those 3 nesting cycles are really what we're looking at, and the downside target is likely 2,700, though it could get down to 2,900 and stop. Where that support is, that would be a 25% drop. 25% drop would be a substandard bear market, a average lasting 14 months, and over 30%, like about 33%. And we think it would be just a normal bear market to get a 30% loss here, getting down to that 2,700 level. That is a look at the stock market and our amazingly long show that we have done here. I hope you have enjoyed the presentations that I brought. If you're watching this on YouTube, please do make sure you give us a thumbs up for all the work that we did. If you don't agree with us, well, I'd love to hear what your comments are on there. And make sure you're nice, because I don't like it when people on there are mean to us, and then I'll just block you. So please do leave your comments on YouTube if you wish. This has been just an amazing amount of work that went into this show to be able to present to you the show for the review of 2020 and our projections for 2021, and our showcase of Ask Slim, which is just a huge amount of information and education that we bring to you with work from our extensive team and analysts and amazing development team that we have that just brings you these incredible new products all of the time. Level 1 revamp, well, that's going to be something that you are just going to love using, and we're going to be building it absolutely more and more. That is it. I want you to be incredibly careful, because it is so crazy out there. And I'm always wishing you great trading.
Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been